So I want to believe that at this point, we would have considered APV as part of our preparation, and maybe we would have maybe looked at one or two questions on it before now. So hopefully this question will consolidate our knowledge on APV. So it is pilot question 1, set 2. So let's get right into it. That's a question. Okay. So before we go right into it, let's do a quick recap, just a quick refresher on APV. Because generally, whenever you have a question on investment appraisal, generally, there are two default methods for investment appraisal. So when I say default method, I mean even in situations where the question is silent on which decision appraisal method to use. So sometimes you pick up a question and it says evaluate whether or not the investment should proceed. It doesn't tell you which method to use. And in that scenario, generally you would have two methods. You would have your net present value, which is APV, or you could have your adjusted present value. Our adjusted present value would be our APV. So how do we know, where the question just tells us evaluate an investment appraiser, how do we know which of this method would be applicable? Especially the question is silent. In the question we're going to solve, it tells us what to do. Loan. Okay, so whenever you have an investment appraisal question, I have information on issue cost, and you have information on subsidized loan. That is an APV question. If you don't have that details, then that becomes an NPV question. So that's basically the key way to be able to identify whether or not the question is APV or NPV when the question is silent on the specific requirement. And let's move on to NPV then. Now, APV rather. So APV would basically split the performance of the organization or the evaluation of the performance of the proposed investment into two. The first aspect is what is called the base case NPV. And the base case NPV is primarily focused on the business performance and business risk. And because it is primarily focused on business risk, it therefore means that we would make use of asset beta in calculating our cost of equity. So we'll make use of asset beta in calculating. So let me not put it cost. So someone that doesn't watch the video would think that I meant asset beta equals the cost of equity. So would you make use of our asset beta in calculating the cost of equity? And that would give us, because we don't have loan, we're just making use of the beta asset, whatever we calculate would be the cost of equity ungeared. Gearing basically implies that you have debt financing in it, but we don't have any debt in that cost of equity. So it's going to be cost of equity ungeared. The second part of our computation would be trying to determine the impact of our debt financing decision. That is what we call the financing effect. So under the financing effect, you're going to consider issue cost, because generally when you raise finance from an external source, you're going to incur some form of issue cost. You're going to look at the concept of interest payments. So whatever the tax savings or tax shield on interest payment is, we're going to consider that. So it's called tax shield / savings on interest payment. And if you do have subsidized loan, you would consider the net benefit on subsidized loans. Okay, guys, that's what our APV would all be about. So we're going to look at what is the base case NPV. And this base case NPV would basically be your NPV discounted with cost of equity ungeared. And then we're going to look at our financing effect. The financing effect will just be 3. We're not going to go out of these 3. We're going to go focus on look and calculate the issue cost. We're going to calculate the net tax shield or savings on interest payment. And then we're going to look at the net benefit on subsidized loan if subsidized loan exists. So if it doesn't exist, then we don't need to do that. But if it does exist, we then evaluate the net benefit. So with that quick recap, let's go to our question and then begin to attack it. So let's go back and read our question then, and then we'll begin to attack it. Okay, so our question says, reads as follows. Ifedayo Plc is a food manufacturer with a portfolio of well-known brands. The founding directors retain a significant minority shareholding in the company and continue to serve on the board following a success 10 years ago. After obtaining the listing, the gearing ratio increased significantly above the sector average as a result of a poorly timed expansion strategy, mainly financed by debt. Earnings became increasingly volatile, and the debt burden triggered a decline in the company's financial performance. The board responded to these problems 5 years ago by pursuing a debt reduction turnaround strategy, which has been financed by a series of rights issues and asset disposals. Even though this strategy successfully reduced the gearing ratio, which is now equal to the industry average, the share price remains depressed due to competitive pressure within the industry. The company's credit rating has recently been downgraded once again. Ifedayo Plc Chief Executive Officer has identified an opportunity to relocate the manufacturing plant and develop a state-of-the-art automated production line, which will reduce the underlying cost base, be a source of competitive advantage. So all of this paragraph it's just been the background information. Nothing really much in terms of figures in there, just been background. Project information. So this is where we begin to go into data right now. Ifedayo Plc's finance director has prepared estimates of the free cash flow generated by the project based on a 4-year time zone. So these are the net free cash flow. So we have the values for 4 years right there. The investment cost is 120 million, which Ifedayo Plc CEO proposed to finance as follows. So they have a net investment of 120 million to get this project up. So they intend to dispose of existing manufacturing plant for 20 million. They intend to have a right issue for 10 million. They intend to have a subsidized loan at 3.5 interest rate. They intend to borrow from the bank at 9% interest rate, total of 120. The bank loan is repayable in equal annual installment over 4 years. So repayment of principal and interest. Issue cost of 2% are payable on gross external financing and are not allowable for corporate tax. So those issue costs are not allowable for corporate tax. Issue costs are payable out of available cash reserve. So basically means that they don't have to look for where to get the money to pay the issue cost. They will just pay it out of available reserve. They have a cash reserve that they would use for that purpose. Very important information. They have cash reserve that they will use for that purpose. The finance director has asked you to ignore the underwriting cost relating to the right issue. Additional information. Ifedayo Plc's current equity beta is 1.418 and the debt to equity ratio is 1.5 based on market values. The risk-free rate is 3% and the market risk premium is 9%. The CEO expects the business risk of the company to remain unchanged as a result of the investment. Corporate tax or business risk is unchanged. Corporate tax is payable at an annual rate of 20%. The board discussed the financing of the project in a recent meeting. The Ifedayo Plc corporate bankers have already approved the funding decision for the 50 million bank loan. But the finance director is concerned about the following capital providers. 1. External shareholders. The last right issue took place 18 months ago, and there were 2 others in the previous 5 years. A group of shareholders have formed an action group to exert pressure on the board for more drastic change. This included a campaign to replace the CEO, which was only narrowly avoided when the shareholders voted at the most recent annual general meeting. The CEO is optimistic about the prospect of a right issue, but suggested underwriting the issue to reduce the risk of failure. Founding directors. The production and marketing directors indicated that they would not be able to take up their rights due to personal commitment, but would otherwise provide full support for the new strategy. Subsidized loan providers. The government funds the subsidized loan program to boost job creation in the economically deprived northern region of the country, which is where the new automated manufacturing plant is to be located. Oh, sorry, I need to quickly admit a few people. Okay, which is, which is where the new automated manufacturing plant is to be located. Although the loan has yet to be approved, the Chief Executive Officer is optimistic about the outcome of their application. One feature of the loan program is that it has been open to applicants without assets available to provide security. Although other restrictions may be imposed, this is relevant to Ifedayo Plc since surplus assets were disposed of during the turnaround strategy, and those which remain will be used to secure the new bank loan. Required. Calculate the adjusted present value of the investment and recommend whether the project should be accepted or not. B. Discuss the factors the capital providers, excluding the bank, will consider before deciding whether or not to approve the funding decision for Ifedayo Plc's investment in a new plant. C. Discuss generally the roles of non-executive directors in major capital investments. Yeah, so there's a question, but I think I have a hand up. Joshua, please go ahead if you have a question or a comment. Maybe I missed that earlier.
Sir, my question is, what year are we solving?
Okay, so this ICANN. Okay, so this is ICANN pilot question set 2. So for the SFM exam for November, because it's a new syllabus, I can release pilot question papers for all of the diets. I don't know if you're aware of that. So for all of the diet, I can release what they call pilot question papers, so that candidates have like an idea of what to expect with the new syllabus. Have you downloaded those before? So this is set 2. So for SFM, they have.
Okay, yeah, so that means the one I had set 1.
Yeah, it's for set 1. So I shared this to the group. I shared this set to the group. I don't know if, yeah, so just take the WhatsApp group, you can download it. So there are 2 for SFM. So there's a set 1 and then there's a set 2.
Okay, thank you. Thank you.
You're welcome. Yeah, right, you're welcome. All right. So that's a question. Let's analyze our question, and then we then begin to solve it. So the first part is to calculate the APV and recommend whether or not we should accept or not. The B part is on the capital providers. So that means that the part that speaks to the capital providers will be from here. The finance director is concerned about the following. The finance director is concerned about the following capital providers. So your capital providers, you're going to be looking at this. You're going to be looking at this because those are the details on the capital capital provider. So those are your B part. Then your C part will just be general question. And discuss generally the rules of non-executive director. So that's a general question. So for our B, we're just looking at the ones that have ticked, because that's the part that is focused on the capital providers. So that therefore means that for our A part, we're not looking at this side. We're not looking at this area for our A. We're already looking at up for our A part. So those are the part that has information that relates to our computation. So let's get right into it. We said that APV computation, you would have your answer broken down into 2. You're going to have the base case NPV, and you're going to have the financing effect. So let's begin with the base case NPV. So if we are given, for example, we are given sales, variable costs, fixed costs, we're going to do all of those computations. Your sales minus your variable cost gives you your contribution, then you minus your fixed costs, and then you can bring in depreciation depending on the method you intend to use. You then calculate your tax, then you then have your net cash flow. So they have done the calculation for us up to this point. They've done the calculation for us up to this point where they've given us the free cash flow. So they've done all the part where you have sales, variable cost, fixed contribution, fixed cost, etc. And they've gotten to where you have the net cash flow, which is called free cash flow. So that is what they gave us here. So let's begin with that part, with what the part from where they've given us the values to. So we'll begin with our free cash flow. We're doing our base case NPV now. So let me put it right here. So I'm beginning with base case NPV. So year 0, 1, 2, 3, 4. So we have our free cash flow, which is after cash flow after tax. Okay. So we're given the value. Just copy that down. So our calculations are in million. So I'm just going to put that in my currency symbol as well. So I have 20.9, 20.6, 28.7, and 104.6. I'll just copy that down. Let's get our currency. Let's get our currency so that we don't mismark. And let's get the company's name, Ifedayo Plc, APV computation. Okay, so let's break that down. So we have 20.9, we have 20.6, we have 28.7, we have 104.6. Those are our free cash flow. Do we have any investments? Value given to us. Go back to our question, it will say, yes, we said that to generate the money from year 1, year 2, year 3, year 4, the investment would be 120 million. So that would be our investment. 120 million. So we're going to have our initial investment. $120 million. Okay, so our net would be 120 million here, 20.9, 20.6, 28.7, 104.6. Okay, so this is our net cash flow. All right, so now let's discount. That's about what we need for that. We're not giving all of the sales variable costs. They've helped us provide all of the information onto the free cash flow, so it makes it a little bit easy. So let's discount. So what would be the discount factor? Now let's go back to our note that we explained, just to do a quick reminder for all. We said that your base case NPV would be calculated, also will be discounted rather, using the cost of equity ungeared. And the cost of equity ungeared is the one that is calculated using asset beta. So let's calculate what our cost of equity would be, but we're going to use asset beta. The cost of equity would be here, cost of capital, this case. Okay, so our cost of equity based on the capital asset pricing model would be that our cost of equity ungeared would be your risk-free rate plus your beta asset or asset beta minus the return on the market minus the risk-free rate. The return on market minus risk-free rate is also called what? It's also called our risk premium. It's also called our risk premium. So let's go right back to our question and see, what do we have? Do we have the risk-free rate? Do we have the risk premium, or do we have the return on market? Do we have the beta asset? So we know if we're calculating anything out of it. So we're going right back to our question. Okay. So additional information, which is here. It says, Ifedayo Plc equity beta is 1.416. However, for our discounting using the cost of equity ungeared, we're interested in what? Are we interested in equity beta? No. We're interested in asset beta. So we're interested in asset, so they call it asset beta, not beta asset. So let me just align it with the words they use. Instead of calling my beta asset, just call it asset beta. So we are given equity beta, but what we need is asset beta? So let's pause on that and go back to our question. So we need to calculate our asset beta because we're not given that. It now tells us that the equity ratio, debt equity ratio is 1 to 5 based on market value. We don't need that information right now in our formula. Right now in our formula, we're just looking at risk-free rate plus asset beta bracket, return on market minus risk-free. So we'll come back to that when we need it. It mentions that the risk-free rate is 3%. And the market risk premium is 9%. So let's impute that quickly. So it mentions that our risk-free rate is 3%. So we get that quickly. Our asset beta, we are not given that. So we can just put that as BA. What we're given is equity beta. Our risk premium, they didn't give us return on market, they give us risk premium. And risk premium is the same thing as return on market minus risk-free rate, which is 9%. So what that basically means is what is remaining for us in this calculation is to find what is our beta asset. Okay, so they use asset beta. So I should use the same word, not beta assets. So oftentimes, textbook interchange it. Some people refer to it as asset beta, some refer to it as beta asset. So let me just stick to what the term they use. So asset beta. So what is our asset beta? Now, to find our asset beta, which is the business risk, we need to ungear. We need to ungear the equity beta. Okay, so what do you mean by that? Our equity beta has both the business risk plus financing risk. Our asset beta requires only the business risk. So we need to be able to take what we are given, which is this equity beta that has both the business and financial risk. We take out this one out of it, and that will leave us with the business risk, which is what we need. And the process of taking our equity beta and removing the financial risk from it so that it leaves us with just the business risk, which is what we need for calculation, is called ungearing. It's called ungearing. So that is what the term ungearing refers to. So let's ungear now. So we can go to a formula sheet, or if you do know the formula, we just pick our formula to ungear, or in other words, to remove the financial risk. So the formula is BA. So that is why I always call it a beta asset, but I don't know why they call it asset beta, but the formula is BA, which is beta asset. So it's equals to VE, which is the value of equity, divided by the value of equity plus the value of debt, 1 minus tax, multiplied by BE, which is the beta equity, or equity beta, is used interchangeably, plus the value of debt, bracket 1 minus T, divided by value of equity plus value of debt, 1 minus T, multiplied by beta debt. Now, because we are trying to remove the debt, which is the financial risk, which is the debt, which is the debt, beta debt is always assumed to be 0 because we're trying to remove it out. It's always assumed to be 0. So when you multiply 0 by any other value, the answer would be 0. Multiply 0 by any other value, the answer will be 0. So what it basically means is that the whole of this place is just 0. All right. So now that we know that, let's calculate what our beta asset would be then. Because Okay, so we need to know what is the value of equity. We know what the beta equity is because we're given it in the question. What is the value of equity? So let's go back to our question quickly and get what the value of equity is. And then what the value of debt is. The question says debt to equity ratio is 1:5. So debt 1, equity 5. 1:5. So debt is 1, equity is 5. So value of equity is 5 divided by the value of equity is 5. The value of debt is 1, bracket 1 minus T. T is the tax rate. So what is our tax rate in our question? Right, it says corporate tax is payable at the rate of 20%. So our tax is 20%, which is 0.2. So this minus 0.2 multiplied by the beta equity or equity beta, depending on how you tend to call it. Those phrases are used interchangeably. So we are given the beta equity in the question. We're given the equity beta here as 1.418. So we're given that as 1.418. We've mentioned that because we're trying to remove the financial risk, our beta debt is always be 0. So 0 multiplied by anything here gives us 0. So there's no need for us to stress our head with that. So plus 0. Okay, so what do we have? So this would be 5 divided by 1 multiplied minus 0.2 gives us 0.8. 0.8 multiplied by 1 gives us 0.8. That is 5.8 multiplied by 1.418. Okay, so what is our asset beta? Beta asset, depending on how you choose to call it. So that's 5 divided by 5.8 multiplied by 1.418. So we have 1.222 as our asset beta, which is what we need to complete our calculation. So let's put it inside our what we have here before. So let's put it inside here and find our value. So that would basically be 3% plus, we've calculated our beta asset as 1.222 multiplied by 9%. So what do we have? That would basically be, you can decide to convert all of the percentage to decimal, and then when you find your answer, you convert it back to normal value, or just multiply directly. So that would be 9 multiplied by 1.222 gives me 10.998 plus 3 gives me 13.998. So I can just approximate it to 14%. So it's 13.998. Can approximate it to 14%. So that's a discount factor rate here. The discount rate rather is 14%. Guys, any question on how we got the 14%? Because that's the crux of basically the base case NPV, your ability to compute the cost of equity using the asset beta. That's the crux of it. Any question on that? Okay, so if there are no question on that, let's find our discount factor for 14% for all of those years. And then we'll then find what our base case NPV is. So I'm going to use my discount factor table. So, but if you wanted to use the calculation, if you wanted to calculate it yourself, you can use 1 divided by 1 plus the rate of return raised to the power of the year, or you use 1 plus the rate of return raised to the power of minus the year. So for my discount factor table, anything raised to the power of 0 is 1. So this is 1. This is 0.877. This is 0.769. This is 0.675. And this is 0.592. Okay, I think I got this too close to my answers. So I don't want to clean this part because I know you guys will need this information when you're reviewing. The fact that beta equity beta is financing risk plus business risk. So I can strip that out. Okay. So let's get our calculation together. All right, so that's 120 multiplied by 1 gives us minus 120. 20.9 multiplied by 0.877 gives us, by my calculator, I have 18.3. 20.6 multiplied by 0.769, I have 15.8. 28.7 multiplied by 0.675, I have 19.4. I wrote that too close to that. And then 104.6 multiplied by 0.592, a little bit above half, I have 61.9. Okay, so what's our base case NPV? So minus 120 plus 18.3 plus 15.8 plus 19.4 plus 61.9, you have a negative of 4.6. Okay, guys, so that would be our base case NPV. Any question on that?
Yes, sir.
All right, so okay, please go ahead. If you have any question on that, please go ahead.
Oh, okay, sir. Why can't we pick the discount factor as 13.98?
Yeah, you can use 13.98, but I rounded up so it's easier to manage. So if you want to use 13.98, you're fine. You're fine. Yeah, okay. You're going to have close to the same answer. But sometimes, when you have decimal points, sometimes it's difficult to manage decimal point. So it's often recommended, if you can, just round up and use the rounded up figure. But if you choose to use 19.998, you're still correct. Is that okay?
Thank you, sir.
All right, then. So we're done with the base case NPV, which is this first part. So let's move on to the second part, which is the financing effect. Now, for the financing effect, we're going to have three things or three elements in our computation. One would be the issue cost of the loan. The second would be the tax shield or tax savings on the interest we pay. And the third would be the net benefit on subsidized loan, if subsidized loan does exist. If subsidized loan does exist. Now, before I get into solving the financing effect, I wanted to quickly spend a few minutes to speak about the discount factor to use for each of these.
Hello, sir.
All right. Okay. Is your hand up? I didn't see that. I would have called you, but go ahead. You can go ahead.
Sorry, sir. I discovered that we went straight to the company's information given. I remember I was looking at a question, and instead of going straight to the company's information given, like all the talk of the premium, talk of the risk-free rate and all those, they used the proxy company. They came up with the proxy companies and information. So I'm confused. at what point should we use the proxy information instead of the company's information in determining the cost of equity on geared?
Okay. So that information, that question you asked it's a very good question. Maybe possibly some people don't know it. So the condition where you would use the proxy information would be where that business or that company is moving into a new line of business. You get that? So take, for example, that a company was maybe primary before now, a company was into banking or decides to go into investment, maybe stockbroking. So because the company is moving from banking to stockbroking, the company's risk would change because that's a new line of business to the company. So because of that, the company would need to look for a company or another business that is into stockbroking, which is what it wants to go into. So whenever you read a question and the question tells you that, oh, this company is moving into another line of business, then automatically know that you're going to use the proxy details. Now, very good question so that you guys would understand this perfectly before I should try and move forward. Because for me, the end result of all of this is that you will attempt any question you see. So let's go and read this question that we just read now. And then I'm going to open another question right now. We'll look at it quickly together and you see the difference in the wording and know why you're going to use the proxy information. So let's go back to this question and see. Is Ifedayo & Co. moving into a new line of business? If it is yes, we should have used the proxy. But if they are into the same line of business, they're not changing line of business, then we don't need to use the proxy because the risk has not changed. Is that clear?
Very clear. Thank you, sir.
Okay, but let's practicalize it so that you know how it plays out. So let's go back to Ifedayo & Co. and then I will open another question quickly so that you have a look at it, which is the reason why we have this session, so we can clarify all of these doubts. Okay, so let's go back to Ifedayo & Co. quickly. Okay, so it mentions here that Ifedayo & Co. is into food manufacturing. Okay, it mentions the company, information about the company here. This about information that the company identified an opportunity to relocate the manufacturing plant and develop a state-of-the-art automated production line, which will reduce the underlying cost base and be a source of competitive advantage. So same food manufacturing, you want to set up a production line for the food manufacturing. You now go down here. Where's that? Look at it. Right here. The CEO expects the business risk of the company to remain unchanged as a result of the investment. Basically, they are moving to the same line of business. It's still the same line of business they are doing, but they're just expanding. So the CEO does not expect the risk of the company to change. So because of that, you don't need a proxy because the risk has not changed. It is not moving into a new line of business. Hope that's clear for this one. Is that clear? Let me open another question quickly. Let me open another question quickly. Just a sec. So we can compare that with the wordings of another question. Okay, so I'm going to just a moment. Okay. So I'm stopping this sharing and I'm opening another question right away. So we can compare the two quickly. Okay, so I have a question in front of us. Adebola Limited. It's a past question. I can't remember what year that is. I can't remember what year that is, but it's a past question. So can you see the question now in front of us?
Yes, sir.
All right, now look at the question. Look at the first line. Adebola Limited is an unlisted company based in Akure, Nigeria. Over the years, the company has been producing and selling agricultural support tools. AL is now considering the production and sale of yam powders. Although this is a completely new venture for AL, I'll stop there. Now look at this point now. The company is considering a new line of business. So before they were producing and selling agricultural support tools. Now they are considering production and sale of yam powders. And it is a completely new venture for AL. So because it is a new line of business that they've not been into, they need to make use of details of a proxy company that is already into that line of business. But if they were still going on, proceeding with their agricultural support tools, they're not changing line of business, then you don't need a proxy because the risk would not ordinarily not change. The business risk would ordinarily not change. Is that clear? Is that clear to identify where you use that?
Yeah, thank you, Sam.
All right, so let's go right back to our question. Okay, so I'm going to stop sharing this. I'm going to go right back to our question. Okay, so we're right back to our question. All right, guys. So right back to our question. Well, thank you for that question. That was a very good one, because I'm pretty sure some other persons might have similar questions. It's always good to clarify that, so that you basically understand why you are doing certain things, not just for example purpose, really. All right. Okay. So we said our financing effect would be our issue cost, our tax shield, and our net benefit on subsidized loan. So when a company decides to borrow money, you incur some form of issue cost. So for a Ifedayo Co, what would be the issue cost? Let's go to our question and see how much do they need and what would be the issue cost. It's not all sorts of finance that might incur issue costs. Not all. So for example, if you are using money that your retained earnings, you don't need to pay any issue cost to anyone. But if, for example, you're issuing shares or you're borrowing money, the bank might charge you some form of management fee, commitment fee, and all of those related fee. So let's go right back to our question and see what the issue cost would be. Okay, so right before that, sorry, I missed my thought. I was explaining something before I got to that question. I think I was writing it somewhere here. The cost of capital. That's the writing that somewhere before that question came in. Oh yeah, discount factor. Yeah, that's what I was explaining here. I was explaining this concept before that question came in. So let me quickly finish explaining that concept before we go back. Now, when you have what do you call it, issue cost, tax shield or tax savings on interest payment, as well as net benefit on subsidized loan, we will always discount. That's SFM for you. We will always discount because we want to know the present value of our inflow and outflow. So what discount rate would we use? Now there is some flexibility when it comes to our exams. Now the issue cost, you're allowed to use either the risk-free rate or you could use the borrowing cost. For the tax shield on interest payment, you can use either the risk-free rate or you can use the bank borrowing cost. For the net benefit, you can use either the risk-free rate or you can use the bank borrowing cost. So you can use either of the two. So what some students would do is, instead of using risk-free rate for one and using bank borrowing rate for another, they just use just one. So they might choose to say, we want to use the higher of the two, which is what a number of authors recommend, that you use the higher of the two. But if you do use the risk-free rate, it's allowed. But some authors recommend the higher of the two. So the higher between our risk-free rate versus the bank borrowing rate. Any of the two is permitted. So there's really no rule. You just have someone to us recommend the higher of the two. So any of the two is accepted. And the implication of this is that you're going to have different answers. So if someone uses the risk-free rate to discount, you're going to have a different answer from someone who uses the bank borrowing rate. Both are acceptable. The only thing would be that I can require that you state what was used. Most authors recommend the higher of the two. All right, so that's something I needed to point out before we go right into our solution. So let me just double check quickly. Which of the two is used in the solution to this question? So at least we have a guide so that when you look at the solution yourself as well, it's easy for you to follow along as well. So just a moment. Do I have that? Do I have? Oh yeah. Do I have? So we can look at this together so that when you're looking at when you find another question and they are using something else, you won't be surprised. So that's why I'm trying to point that out. You can use the risk-free rate, or you could use the cost of borrowing. Anyone you use is correct, but a good number of authors would always recommend the higher one to be conservative really by using the higher one. So just a moment, let's look at that together, and then we'll come back and continue our solution. So let's start Pathfinder. I think I had it. Oh, why did I download that? Oh, okay, yeah, I think I have it open. Okay, can you guys see my screen?
Yes, sir.
All right, so let's go to the solution on that part quickly. Just wanted to point that to you guys. It's always important so that when you are looking at questions, you don't get confused or begin to say, oh, why is this, why is this that way? So you get that straight up from the very beginning. So these are the questions. So let's go right to our solution quickly. Okay, let's go to our solution quickly. Okay, yeah, this is it. So I don't know what 9% is. I don't know what 9% is. I need to check the question, but it mentions here that the risk-free rate would also be acceptable as a discount rate. That's because there's that provision. So if it mentions that the risk-free rate would also be acceptable, it therefore means that this 9% is most likely the bank rate. I don't know except we look at the question. But if you just point it out to you guys that sometimes you might have the risk-free rate is used, or you might have the bank rate. All right, so let's now get back to our question and begin to solve it. So whichever one you use, so that you don't get confused when you see different solutions with different, maybe different packs or something on that. So let's now go back to our solution with that clarified. Let's go back to our solution quickly. Yep. So that's the beautiful thing about SFM. Sometimes you can have three correct answers in SFM, as long as you're able to state what assumption or what you're using. It would oftentimes fly in most situations, except the question specifically says use this. If it doesn't say specifically use this, then you sometimes have that that flexibility. Okay. All right, so good. Let's go right back to our question, then I begin to solve our question. Now, without out of our way, let's go to our issue cost. We discussed the concept of discount factor. So let's go to our issue cost then. What would be the issue cost? Let's look at our question quickly on that. Okay, so the company needs 120 million, which Ifedayo Plc CEO proposed to finance as follows. So how does it propose to finance it? Disposal of existing manufacturing, right issue, subsidized loan, bank loan, total of this. The bank loan is repayable in equal annual installment over 4 years. Issue cost of 2% are payable on gross external financing and are not allowable for corporate tax. So the 2% would be on external financing. So we need to look through this and identify which of them is external financing. When we say external financing, we mean sourcing of from money from external sources. This is you selling your assets. So it's not as if you are selling for finance, asking somebody give me. It's not as if you're asking someone give us money to finance that business. You're just selling your asset. So this is not an external finance. Right issue is a form of financing. So you can raise finance through equity, which includes right issue. You can raise finance through debt. Subsidized loan is a loan. Bank loan is a loan. So our external financing would be our 10 plus 40 plus 50. So how much is that? That would be 100 million. Now, but before you proceed, you need to pause and ask a little bit of question to say, okay, are we going to borrow from these external sources? If we borrow 100 million on the dot, if we borrow or we source for 100 million on the dot, does the company have the finance? Does the company have the finance to pay for the issue cost? So just like somebody telling you, I can borrow you 100 million, or you need to pay me management processing fee for 10 million. I need 100 million. The person says, I can borrow 100 million, but you need to pay processing fee for 10 million. Now, if I don't have any reserve anywhere, I don't have any cash left anywhere, and I borrow 100 million on the dot, and I have to pay the person 10 million, what I will have left will be 90 million. And this will not be sufficient to meet the requirement. So that will not be sufficient to meet the requirement. And that's the truth. So I need to borrow more than this 100 million. Maybe I need to borrow 110 instead of 100 million. So that from the 110, I will pay 10 million, and then I'll be left with the 100 on the door, which is what I need. And that would be if I don't have any money, any reserve somewhere to pay that 10 million. But what if I had a reserve somewhere? Maybe I had a reserve of 10 million somewhere. I will just borrow the 100 million on the dot, and then I will use my reserve to pay for the issue cost. So the question we need to ask ourselves is that this issue cost of 2%, whatever it is, does the company have the resource to pay for it from their pocket? If they do, we just borrow the 100 million straight up, and then go to our savings and remove what we need to pay for the issue cost and pay them, and we have 100 million for our project. But if the company does not have the amount, then they need to increase their borrowing by the issue cost. So by the time they get the borrowed amount, they can now remove the issue cost and pay out of the amount they borrowed, and the remaining one will be exactly 100 million, which is what they need. So that is something we need to be able to answer from the question. So let's read our question. It says, issue costs are payable out of available cash reserve. So Ifedayo has a cash reserve somewhere that they can use to pay the issue cost. So because they have a cash reserve somewhere, we're going to borrow just the 100 million on the dot. Whatever the issue cost is, they will pay it from the cash reserve. So what is the issue cost? 2% on external loan, 100 million. If you have any question on that, please ask, because it's very important you get that point. Otherwise, if you use the wrong amount at that point, all your answers from there going forward will be wrong. If you borrow the wrong amount, all your values from that point going forward would be wrong. So guys, please, if you don't understand the concept of issue cost, please ask. So let's look at our issue cost. Our issue cost would be 2% of 100 million. which would be 2 million. Any question on issue cost, guys? I need us to get this concept, please. Very important to be able to distinguish between a situation where the company or the organization has the issue cost on ground versus when they don't have the issue cost on ground. Any question? Okay, so maybe I could just add a note, a one-liner note to that. Okay, someone hand is up. Okay, please go ahead. Sorry, I can't see the name yet. It's not showing up yet. Let me recheck that. Okay, I can see it now. Okay, Olusheye, please go ahead.
Well, thank you, sir. Okay, so can you just quickly recap on the issue cost? I mean, how we can take it out from reserve and all of those, and just a brief recap. Thank you, sir. Okay,
so the recap is this. If you need, I'm going to use it as an example that you can relate with. If you need 100 million, right, for a project, and the bank is telling you, and providers are telling you that for us to process this 100 million, you need to pay an issue cost of 2 million. Now, if you don't have this issue cost saved anywhere, if you don't have it saved anywhere, you cannot borrow 100 million on the dot. The reason is because if you borrow 100 million on the dot and you have to pay 2 million, how much will you have left? 98. And this 98 will not be sufficient. Because what you need for your project is 100 million. So because of that, you have to borrow an amount that includes the issue cost. So to determine that amount, there is a formula for that. So that would be the amount required divided by 1 minus the issue cost. So that would be 100 divided by 1 minus, our issue cost is 2%, so that is 0.02. So that is 100 divided by 0.98. What's that value? So that would be 100 divided by 0.98. So that would be 102.4. This is the amount you will borrow. And the reason is because when you borrow this amount and the bank charges you 2% on that amount, how much is 2% of 102.4? 2 divided by 100 multiplied by 102.4. So that would be 2.0. 2.05. So this will give you approximately 100 million, which is what we require. I want you to get that point first before I move forward. Is that one clear? Is that point clear, sir?
Yes, sir. Very clear, sir. Very direct and clear.
Yeah.
Thank you,
however, if you have the money, I have 2 million saved somewhere. I don't need to increase my borrowing because I already have this 2 million saved somewhere. So I will just borrow the 100 million and then I will go to my reserve. I remove the 2 million and pay the issuer. And I have the 100 million that I need for my project. Is that clear? Now, that concept is very important because if you don't get it right, all your values from that point onward would be wrong. From that point, all your values from that point onward would be wrong. So please, you must not miss that out. Okay, so we established that we're going to borrow, our issue cost is 2 million. So I think that we're done with the first part, which is our issue cost. Yeah, so we're done with that part, which is our issue cost. So we've calculated it as 2 million. Second would be our tax savings on interest payment.